Okay, let's continue our discussion on this week's wild market conditions with Tony Crescenzi, PIMCO market strategist and portfolio manager. Good to see you here this morning, Tony. It's been a while. Look, we just got commentary from Fed Chief Jerome Powell moments ago saying they are acutely focused, that is the Fed, on fighting inflation. Do you think this market has fully priced in a more aggressive Federal Reserve?
We don't know, and that's the angst that the markets are displaying once again today and, of course, yesterday. There's a wide band of uncertainty regarding how high the Fed has to go in order to fix the current inflation problem. Market participants are quite confident that the Fed will ultimately be successful. In fact, as we know, there's an adage, don't fight the Fed, and don't fighting the Fed today means believing in its idea that the inflation rate will go down to the 2% objective that Jerome Powell, the Fed chair, mentioned today. The issue for markets and market participants is what it will take to get there. Currently, market participants think that the Fed will move to about 4% on its funds rate, add in the equivalent of about 100 basis points of tightening from its balance sheet reduction, $1 trillion per year, 3 years, equals roughly a point in terms of total monetary tightening. So 500 basis points of total monetary tightening is now built into market prices, and there's a substantial negative fiscal impulse this year, a $1 trillion reduction in spending, according to the Congressional Budget Office, to $5.8 trillion. That brings the deficit down 8 points to 4.2%. And the last component of this tightening is, of course, the pain that we're all experiencing in the financial markets. Financial conditions indices suggest the biggest tightening of financial conditions in magnitude in terms of movement since 2008, and perhaps on par or equal to, or greater than. The level of financial conditions could be considered still helpful to the economy, if you will. They're still not tight overall, but the amount of tightness has been severe. So there's a lot of uncertainty, a lot of tightening built in, but it's still not enough for the average market participant.
Tony, off of Fed Chair Powell's comments this morning, we've just seen the Dow turn negative here after being up triple digits. And so for the markets that are trying to price in all of the Fed speak that's been taking place, how far out are the markets looking, if we can put a timeline on this?
Well, I struggle to give an answer because there's even 1 month's data could change the view materially. We saw that last week with the CPI. It changed views materially. So did the University of Michigan Consumer Sentiment Index, which showed inflation expectations rising. It's something that the Fed chair mentioned as one of the factors that led to the 75 basis point increase. And so market participants will be on edge with those types of data, inflation data, for some time. So market participants are confident the inflation rate will come down. You see this in the inflation products. You see it in various gauges the Fed looks at, something called the five-year. There are numerous things that suggest market participants are confident, but it's the general public that has to be convinced in a Volcker-esque type of way, perhaps. And that's the worry. And if you did a search on Mr. Volcker, you'd see lots of stories about and references to Mr. Volcker today. The Fed chair, of course, tightened aggressively to fix the 70s inflation problem that many say is a result of lax policy from Fed chairs Arthur Burns and G. William Miller from 1970 to 78.
Tony, well, if we're back in a Volcker-like environment and we're seeing a period of stagflation, in this environment, where does that general public go to make money?
Well, we are all experiencing turbulence. Investors are experiencing turbulence, and we're all pilots to our portfolios. And what does a pilot do in an airplane when there's turbulence? Try to find smooth air. How does an investor do that today? Simply by taking a long-term orientation. You have to think about the various types of companies and sectors that one thinks will fare well in the years to come. And on the interest rate front, we would say that today's interest rate levels are quite attractive for fixed income and other investors. Think about the Bloomberg aggregate, a yield of about 4.1%. That's well above what's expected to be the inflation rate, at least according to Jerome Powell today, who said the Fed's acutely determined to get the inflation rate down to 2%, and let's say the Fed doesn't get it there and gets to 2.5 or even 3, there's a good cushion now, a real yield, as they say, a yield that's above the expected inflation rate. So an investor should take the long-term view and perhaps think about where they were a year ago when yields were in the ones and when they were dreaming of the idea of getting 4% on high-quality bonds. And so take the long-term view.
So for investors that are looking for that smooth air, particularly we've heard from companies that are investing for the next 3 to 5 years in that next wave of growth. But in a recessionary environment, if you see cutbacks on spending or at least or even restructuring within some of these companies, and that retracts or retraces some of that vision that they had put out there and said we were going to be spending aggressively on, how vastly different do these companies look versus now? And going into the future, are they still going to be spending towards some of those larger goals?
Well, you're right that in the near term, there will be cutbacks and even verbal commitments on things will perhaps be scaled back. This is the normal human reaction to react to fear and anxiety, which is to retrench a bit. But ultimately, at least this is what's occurred for decades or even literally hundreds of years, the capitalist mindset will likely return. This idea of the profit motive and also the desire to live better. Think of Adam Smith in the 1700s in The Wealth of Nations, who said basically that people in desiring to improve the way of living would improve and increase the wealth of nations. And so you should put your faith in that, because we all want to live better and have better things and to make more money. And so that's still intact. And so there'll be certain companies, perhaps sectors, that don't make it out of this. That's part of the creative destruction process. And that's why it's really important to think from the bottom up as well as the top down in terms of the types of sectors, companies, et cetera, that will thrive in what we think is a very bright outlook.
Tony Crescenzi, who is the portfolio manager and market strategist over at PIMCO. Thanks so much for joining us this morning with your insight. We appreciate it.